In today's video, I am going to show you how you can pay $0 investing in stocks using a very specific option strategy. We are going to go through everything step by step and make it very easy to understand so you can apply this strategy to your investing, or at least not pay so much for your investing and still hopefully make some money. Okay, so stocks represent a piece of ownership in a company. When you purchase a stock or a share, you are essentially buying a tiny slice of that company, making you a partial owner or shareholder. Think of a giant cake, right? Where every piece of the cake symbolizes a share of the company or the cake. As the company performs well, the value of your slice can increase. And if the company loses money, well, then your shares can go down in value. So that's pretty simple to understand, yeah? So you invest in the company by buying shares of that company. Now, let's talk about options. Options are financial contracts that give you the right, but not the obligation to buy or sell stock at a specific price. For this video, we will focus on call options. So call options are contracts which give you the right to buy a stock. Now, an easy way to think about this is imagine a voucher that you have that lets you purchase your favorite products at a fixed price. Now, even if that product's price fluctuates up and down in the future, you still have that voucher that says you can buy this product at this price. But how does this voucher or call option work in detail? Well, there are three main terms to understand. First, there is a strike price, which is the fixed price that you've reserved to potentially buy the stock. The next is the expiration date, and this is the deadline for your option. Think of it as like an expiration date on perishable goods. If you don't use the option by this date, it becomes worthless. Lastly, the premium is the price that you pay for this special voucher, the call option. Much like a reservation fee, it's the cost for securing the right to buy that stock at the strike price before the expiration date. All right, next step is to understand covered calls, which is the specific trade that we will set up for this overall strategy. So let's unpack the covered call strategy. Now, the first thing to understand is that in options, you can either be a buyer of a contract or a seller of a contract. Just like any market, you have buyers and sellers. So for covered calls, you are selling an option contract. The name covered calls comes from the trade being covered by the stock that you own. So in order to sell call options, you need to already own at least 100 shares of the company for every one call option you want to sell. And that is because one option contract controls 100 shares of the underlying company. So let's see how this works step by step. Picture this. You've invested into shares of a company, let's say Microsoft. You now own Microsoft shares. Now, with a covered call, you're essentially setting up a deal where you're offering someone the chance to buy your Microsoft shares, but only if the price of Microsoft hits a specific target price within a certain time frame. This again is known as the strike price and the expiration date. Target price, strike price. Certain time frame, we use expiration date, okay? So you know the terms. So again, the buyer of your option contract can only buy your Microsoft shares if it reaches the strike price by the expiration date. Now, for the seller, for this potential buying opportunity, they pay you a fee upfront. This fee, remember, is called the premium. Now, what outcomes can we anticipate from this deal? Well, firstly, if Microsoft does not reach the strike price by the agreed time, which is the expiration date, the deal expires. The individual does not buy your shares, and you get to keep both your Microsoft stock and the premium paid to you. It's a bit like charging somebody for a reservation that they eventually don't use. However, if Microsoft stock does go up, surpassing your strike price, the buyer can execute his right to buy your shares at the strike price. Now, the buyer in this case is hoping that Microsoft goes above the strike price so that he can use his contract to buy shares at the strike price and then sell it on the open market at the now higher price. Instant profit for them. So if Microsoft goes above the strike price before the expiration date, you are then forced to sell your shares at that strike price, regardless if it is a higher price at the time on the open market. Now, while they benefit from getting the shares at a price lower than the market rate, you've also gained, right? You not only received the premium, but also made a profit from the rise of the stock's price up to the strike price. So in essence, both parties can find value in this arrangement. All right, so let's go through an actual example using Microsoft. So let's say you bought Microsoft stock at $85 per share, and it goes up, and now it is sitting at $90 per share. So far, so good. You then decide that you want to create this arrangement with the buyer of your shares through an option contract. And the contract states that the buyer of this option contract has the right to buy your Microsoft shares at the strike price of, let's say, $100 per share. And let's say the expiration date is 1 month from now. They will then buy this option contract from you and pay you a fee, which again is called the premium. So let's say the premium is $5. They will pay you $5 per option contract right away, and that money goes into your account. So now you've just collected some free money basically for selling this option contract to the buyer. Now, if Microsoft reaches $100 before the expiration date, then what happens? Well, then your shares will automatically get called away from you, as you are now forced to sell your shares to the buyer because, well, that was the agreement that you made per the option contract. You still get to keep the premium that they paid you, and you then sell your shares at $100. So let's take a look at what happened. You made money on the stock, right? The price rising from $85 of which you bought it to the now $100 that it is now. So you made that profit. You got paid a premium, which is just extra cash in your account, and now you don't own the stock anymore. Now, if Microsoft does not reach $100 and it only reaches, let's say, $95, well, then you still made a profit from the stock rising from 85 to 95, but you keep your shares and you still keep the premium that is paid to you. This is the ideal scenario when using the covered call strategy as a way to generate income. Now, if you do this process over and over again with the same ideal outcome, you'll sell a covered call, you'll get paid the premium, the stock won't reach the strike price, you get to keep your shares, and you've made the free money in the premium paid to you. You do this again and again and again each time, and then you just collect that premium over and over for selling these option contracts. So in essence, if we think about it, if everything works out in your favor, you are using the covered call strategy to generate consistent income off owning shares of a company. Now, here is where it gets interesting. In our example, we spent $85 initially of our own money to buy a share of Microsoft. You then sold a covered call and collected $5 from the option buyer. Now, this premium paid to you can be factored into your cost basis of your stock. So in essence, we can think of our cost to buy a share of Microsoft being only $80, which is the $85 minus the $5 premium we got. This brings your break-even price at a lower price as well. So let's say you never sold a covered call and just owned the stock. If that stock drops below the $85 that you paid for it, then you lose money. So your break-even price is $85. But if we apply the covered call strategy, our break-even price becomes whatever you paid for the stock minus the premium that you collected. Now let's continue with this idea further. If you sell another covered call, you collect another $5. Well, then what happens to our cost basis and break-even price? It goes down yet again. We've paid $85 for the stock, but we got $10 in return. Well, now our cost basis is $75. This means that the stock can fall to $75 and you won't lose money on your investment. So now you're probably asking yourself, hey, Alex, can I just continue to do this, sell covered calls until my cost basis goes all the way down to, I don't know, $0? Well, yes, you can. Hence the title of this video. So yes, the more you sell covered calls, the more premium you collect. The more premium you collect, the lower your cost basis becomes. And if you do this enough times, you'll end up collecting all the money that you put into the stock. Now again, you have to remember that this is considering that the trade plays out in your favor in the ideal scenario that we spoke about earlier. The stock never reaches the strike price, so you get to keep your shares. Now, there is a lot of specifics that go into putting the odds on your side. And in fact, I made a whole entire video just on that. What strike price to choose, what expiration date to look for. Click right there, watch that video. All right, now we need to go over the risks, because even though, in my opinion, selling covered calls is the closest thing to free money, there are still some things that we need to be aware of when using the strategy. The first thing is the obvious. You buy shares in a company and for some reason you're unlucky and buy the top of the market, and then the stock just continues to go down from there. Well, then you would, of course, lose money on that investment, once you sell. You can still sell covered calls. However, this is tricky because you would be setting up your strike price closer and closer to the price that you bought the stock at. This is why it's always important to sell covered calls with the strike price that is above what you paid for the stock. Remember, if the stock price hits your strike price, then you will be forced to sell your shares. And you don't want to sell your shares below what you paid for them. This is why it is very important to sell covered calls, again, with the strike price above your cost basis. The second risk would be, of course, that you would lose your stock. So let's say you bought shares in a company and that company has a rally. The stock price shoots up past your strike price. Then, of course, you would be forced to sell your stock and no longer own it. Now, some might think that this is not a risk if you're not worried about losing your stock, because remember, we're selling a call option above our cost basis, so no matter what, you would still be in the profit with your long-term stock. So if you bought shares at $100 and you sell a covered call at, let's say, $108, and the stock goes up above that and reaches $112, well, you would still be in the profit at $8 per share. You would then sell your stock and collect that $8 profit. Now, keep in mind that this will come with a tax implication, right? Because if you sell anything at a profit, that will be taxed. So you have to consider this might be a risk on your end as well. Okay, now let's say that in our scenario, the stock reaches $112. Remember, you bought it at $100 and you sold the covered call at $108. Well, in this case, you wouldn't actually lose money, right? But you would lose the potential of making extra money, if that makes sense, right? From $108 that you sold it at to $112 that you could have held the stock for. So this might seem like a loss because you could have made that extra money, but remember, you sold a covered call and collected a premium at $108. So you profited the $8 a share, which is still profit. So let's say the stock keeps going to $120. Well, what did we lose? Well, we didn't lose money per se because, again, we bought at 100, sold at 108 through our option contract, but we lost the potential to gain that extra bit of profit from 100 to 120 now by locking in a capped profit by using a covered call. So the risk here is you are losing the potential to make more profit. Now, this is more of a psychological thing that you're gonna have to get used to, because there will be times when you sell a covered call and the stock price exceeds that strike price. In your head, you're gonna say, oh, I lost the money. But again, the only way to lose the money is if you don't sell a covered call above your cost basis. Profit is still profit. Keep that in mind, and we can move forward. So you can see that there's always going to be a battle between rising stock prices and getting that strike price just right. Now, obviously, you want to collect as much premium as possible, which means to bring your strike price as close to the stock price as possible. But again, it's a balancing act. Too close and it might exceed the strike price. Too far away, you're not collecting as much premium. If your shares get called away, you will still be in the profit. And profit is profit. So now that you understand the risks, you can have a better understanding of the idea and strategy as a whole. Invest in good stocks that you want to hold and grow over a long period of time. Sell covered calls and collect the premium. Continue doing this over and over and hope that the stock price does not reach the strike price. And use that premium that you collect to chip away at your cost basis until it gets very, very close to zero, if not zero. And over a long period of time, this is absolutely possible. Now, if your stock does get called away, which will happen, you can go into a wheel strategy by selling cash secured puts. Now, you're probably asking yourself, hey, Alex, what is that? Well, thankfully for you, I made a video on this topic, which is the next step after you learn the covered call strategy. You can click right here or click here and here, watch my other videos. Thank you all so much for watching, and we will see you in the next video.